Hello, Baker Investment students. It is Sunday, June 4th. Hope everyone had a great week, and the markets did fairly well this week, so I was happy with that, and especially happy to see the politicians work things out and get the debt deal finalized. This doesn't mean it's over. We're still going to have this issue every year, especially with the dynamics of the politics, but as Treasury Secretary Janet Yellen pointed out, it's starting to get critical, and it's concerning, too, because you generally consider the U.S. government like the risk-free rate. You'll be reading about risk and return this week. And if the U.S. government defaults, I don't think enough people realize just what a financial Armageddon that would have been if we would have started defaulting on our debt. So at least cooler heads prevailed, and we were able to get something passed. Doesn't mean that we don't need to kind of discuss and have discourse and work through the issues that we have and how we're going to fund Social Security and Medicare and Medicaid, all these things in the long term. Bottom line, something's going to have to change. It's either going to be we're going to have to raise taxes, which a lot of Americans don't like, or we're going to have to reduce benefits. So something's got to give in the long run. So we'll see what happens. But at least for now, the stock markets were happy with that news. And then we'll see how the rest of the month of June goes. So for this week, you'll rinse and repeat again. Continue with Chapter 3 and 4 in your readings. You'll do a forum discussion post. You'll track this time. How did your portfolio do? I'll track along with you. And it's fine if you want to pick Thursday as that date that you want to post your results. You can do that as the end date. And that way you can post it on Friday, or you can post it the Thursday evening. Or you can wait till the Saturday. But I was happy with the forum post and the stocks that you picked and everything, so everybody's on track for that. So keep doing that, and we'll see how we do as a cohort over this time period. So there's a lot of unknown variables that can happen, but hopefully we'll see some positive returns over this time period of our course. So, all right, so Chapter 3 deals quite a bit with investment information. As I mentioned before, I think I love to go to CNN Money. I love LaMonica. He's a great author. But usually they give a good snapshot of things that are going on. There are other websites such as The Motley Fool, Investopedia, CNBC. So there's a wealth of financial information. When I started off in this business, when I was a senior in college, my first exposure was working for a broker. And in no way did you, this was an internship, but in no way did you ever have this much access to information as an individual. So that has really changed in the 30 plus years that I've been in this business. Even, we used to trade stocks on fractions. So I was pretty good with fractions at 1/8 point, knowing 3/8 is like 0.375. So everything would be traded that way. But finally, around the turn of the century, they got smart and said, well, why don't we just using pennies? It just makes things easier. So, but again, we have to remember all this goes back to having financial goals and a financial plan, why we're investing. And when I was talking to my son about this, he's going to be a junior at University of Missouri. He was asking me, well, he's got a Fidelity account. He doesn't have a lot of money in it, but he has a Roth IRA. And he's saying, well, Dad, should I be investing some money in some things for myself in the stocks? And I said, well, it kind of ties to tax strategy too. You really want to be putting as much money as you can away to avoid tax liability. Now, with the Roth IRA, you're not going to be avoiding it immediately. You're going to be paying the taxes, but it's in the future. So I told him, someday you're going to get a job. You're going to start working. They're probably going to offer a 401k plan. They'll match up to 5%. But I was trying to tell him, hey, you need to take advantage of, as much of those tax strategies as you can, fund those as much as possible, and then you may want to try to start investing on your own for other things. Now, there are certain things that probably he wants to save for a home and do things like that you may want to put some money into a money market, or if you're willing to take on more risk to do something like that. But again, it's a good example of financial goals. So I'm trying to help educate him and try to steer him, but all our investment strategies, whether it's for personal or for the corporation, what is the bottom line goal? For most corporations, it's try to reinvest in the company itself and try to have growth strategies, or invest in the right products or services, or invest in the right people. So, all right. So with this, you're going to have both descriptives. If you go to looking at information, Yahoo Finance is a great one. You could just type in the ticker symbol. Like when I was in college many years ago in graduate school, I did a stock analysis of Kellogg's. So I'm very familiar with that company. I put in the stock letter K. It gives me all kinds of information about the price, how the price has fluctuated over a period of time, earnings per share, the beta, things that you all will learn about through this course. It may give a little bit of background about how the company has performed and some financial statements such as income statement, statement of cash flows, and a balance sheet. Have you access to it? If you have access through your 401k, like I will have through Fidelity, sometimes you'll actually get analysis. You'll get a little bit deeper dive, and you're paying for these things directly or indirectly, through work, through your 401ks, or if you have like something like Fidelity, or the textbook mentions about the line, kind of the highest price ones are going to be the Merrill Lynch. The next step is the Fidelity, and then you have something very cheap like a Robinhood, where you're not going to get very much information. So, but nevertheless, there's information about there daily. Now, the other thing you have to take with a grain of salt is also, if you believe in efficient market hypothesis, even if this information is available, it's really kind of irrelevant, because everything should be priced in the market, and as soon as any new news comes out about this company, the stock price is going to adjust. Okay, but that's mostly just dealing with the stocks. We're going to talk about bonds and other things in this course too, and different types of investments. But the reality is, if markets are efficient, you can do all this research and everything. It's still good to do the research and find some background on the company, but there's no guarantee that you're going to be buying the stock at the right price and it's going to give you a guaranteed return. There's nothing guaranteed in financial markets. So, but with that, the chapter also talks about averages and indexes. I want to kind of go over that a little bit. The Dow Jones Industrial, that's been around since the 1800s. It was actually started by some three guys. I can't even remember the third guy's name, and it was too long, and that's why it was cut off and just called Dow Jones. So in history, he's kind of been ignored. But a lot of started off with just railroad companies. And an average just means you're taking these prices in these stocks and you're dividing by a divisor. So the Dow Jones Industrial has changed over the years with the companies being in the Dow as those have changed. And that divisors had to adjust too mathematically, because sometimes companies, they split their stock price. So something that would have been one share for 100 now is two shares for $50. So they have to adjust the denominator divisor, and that's how it comes up with Dow Jones Industrial Average. And an average, is simply that. It's just an average. It's like a batting average. And people have tracked the Dow Jones Industrial Average for years. It's just always been kind of the news flash, just kind of how the market is doing for the day. But really, the S&P 500 is a much better, broader measure of the market, because you're including 500 companies, not just 30 companies in the Dow Jones Industrial Average. But with an index, what you're doing is you have to start at a base year. It's kind of like the Consumer Price Index when you're looking at a basket of goods. If that basket is just simply a hamburger, French fries, and Coke, and what was the price of that basket this year? And what is the price of the basket the next year? What's the percentage increase? So you're looking at that baseline and how much is increased from that baseline each year. So they're looking at percentage changes. And that's the difference with an index. Okay. So with that, when you start to look at Chapter 4, you're going to get into some of the basics of returns. Obviously, with stocks, the big returns are either through dividends. But we should really hold, for all times of investments, it can be income. So anything that generates income to you. Then there's also the capital gains. That is the adjustment on the price. And that is if, is it on paper? A lot of mutual funds will measure these things on paper. If you own a bond, you have to adjust to what the price of the bond is that day, even if you haven't sold it yet. So we call that price mark to market, as if you were going to sell that today. But that's why, mutual funds and the net asset value changes up and down daily, because they have to go out and kind of say, hey, what is this bond worth, or what is this stock worth? And then you type this, that present value is probably one of the most important concepts in finance or investing. What is something worth to me today? My mother-in-law were looking to, she inherited some oil lease rights. And I tell you, it's been an absolutely mess having to deal with this, because it's such a small dollar amount. But, what I'm doing is I'm trying to transfer this to my wife, so she hopefully can live on 30 plus years and have these oil rights at the oil rights in Kansas. But the dollar amount is really kind of very minimal. It's only like $200 a year of that. After you deal with the taxes and the headaches and all the depositing it, it's almost not worth it. So I went to my uncle and asked him, hey, do you want to sell your share? Because he was given a certain amount in the inheritance, and maybe it will make it worth it. Also help to clean up some estate planning for my mother-in-law, so it's off her books, so everything's clean when she passes, hopefully many years from now. But nevertheless, I had to do kind of a present value analysis and look at, hey, what are these cash flows been on these oil rights? And it's a very small interest share. It's a very minimal amount. And what would they be worth to someone? And again, it's also risk involved, something you read about in this chapter, because an oil well, you got to remember in the Kansas, Texas, and Oklahoma, there were a lot of these wildcatters, especially in the 50s, 60s, 70s, that started these oil wells, and they were sold off, and you have royalty rights to these wells. Well, it doesn't mean that the well is going to last forever, so you have to assign some risk to that too. So basically, I sat down with my uncle, and we kind of did the math, and he said, okay, I would agree upon this price of say $1,400 for to sell you the rights to these oil rights, and I said that's a fair price, based on the risk and the return that I was willing to take on. So, but obviously other types of risk you're going to look at and examine this chapter. It can be liquidity risk, how quickly it can convert to cash, purchasing power risk. We've had a lot of issues with that recently with inflation. That's been a big concern. You could also have things as interest rate risk. You're going to affect bonds because we've seen the interest rates continue to rise. And we may even see another rate increase by the Fed in June. I think the market's starting to price that in a little bit. And there can also be tax risk. What if the tax laws change? You invested in a certain type of security based on the information you had about tax laws at that time, and the tax law changed, so that can impact your risk. But bottom line, one of the best measures of risk we like to look at investments and finance is standard deviation. I grew up in the 80s, so I want to give you my Pac-Man analogy. So you think about when you look at standard deviation, you're looking at something like an average of the returns, and then you look at one particular year, and you look at that difference between the average, and you square it. And you keep doing that over and over again. You divide that by the number of observations, n-1 typically if it's a sample standard deviation. And that's what gives you the variance, okay? But you take a square root of something, like think of this variant floating around here. Here's Pac-Man, waka, 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 waka. Hopefully that's entertaining for you all. But when you take a square root of a variance, you're reversing out everything you squared. And that's what we call standard deviation. So standard deviation is a great measure of risk. And obviously stocks or investments that have higher standard deviations have higher risk. And you would hope to be compensated for that higher risk. It doesn't guarantee you're going to be compensated, but that does influence, how much you're willing to pay for something and your expectations, whether it's a bond or a stock, for the risk that you're taking on. So, but you're going to see, like in the textbook, they're going to talk about this risk spectrum, going from a very risk-free rate of a treasury bill to something that's very high risk of a futures, which is a derivative. And then you have kind of common stocks, higher along that scale, and then bonds, kind of somewhere lower. So, but we all have different levels of risk. Most of us, I would argue, are risk adverse. We want to try to avoid risk, but having some knowledge about the standard deviation stocks and bonds and other investments will help us construct a portfolio that at least attempts to try to reduce some of that risk. So, okay, well, I went a little bit longer than I wanted to, but there's a lot I wanted to talk about. But I hope you all have a great week. Good luck with your portfolios. I'm curious to see how they do this week. And again, if you do have any questions, just reach out to me via email, and I'll get back to you as soon as possible. Have a great week.